All right, so in this video, we're gonna do things a little bit differently. You can see the setup is a bit different here than what you're used to, but I think this is probably the best way to present to you guys 20 stocks that are high growth that I think could be some great winners in 2022. We usually spend, every month going over top 3 growth stocks, top 5 growth stocks, something like that. But I figured, you know what? It's gonna be a new year soon. There's a ton of value out there in this sector. Let's start off strong. Let's start off 2022 with a bang. And let's go over 20 different growth stocks. So take a second to subscribe, smash the like button. If you enjoy this, let me know in the comments down below which one of these 20 is your favorite. And if you're curious to see which ones of these I buy, further analysis on them, discussions, all that kind of stuff, consider joining our VIP group, link description down below. So now for all of these stocks to make it on this list, there were 3 different criteria that I filtered by. So all of these stocks meet these 3 criteria. The first is that they need to have a market cap under $50 billion. I believe, under 50 billion, it gives us the potential for a pretty big multi-bagger over the long term. So that was one I was looking for. The second is I want to see at least $1 billion of revenue annually. I don't want to see like any small businesses that are producing a couple hundred million or tens of millions of dollars, something like that. I want to see at least $1 billion per year. So all of these businesses do that. And the most important criteria for this video, I want to see these stocks growing by at least 20% year over year in terms of their revenue. So that's it. If the companies meet these criteria, they're on the list. All right, so now let's jump over to this chart here. We can see I have a whole bunch of stats, percent off the highs. This is as of recording this video today. I've posted the current market cap for your reference, what their 2022 revenue estimate is expected to be in billions of dollars, what their growth rate is expected to be year over year. And I threw a few more interesting metrics to, give you a bit more context as to what these businesses do from a fundamental standpoint. And, if they look attractive to you, maybe it's worth looking into further. So free cash flow is one of them. You see that's also in billions of dollars. Net debt. So this is an important metric to see the financial health of a company. And if you're not familiar with this, if the number is negative, that's actually a good thing. If the number is positive, that means they actually have more debt than they do cash. And then finally, the average forward price to sales ratio. So typically, if you watch my videos, I like to see a price to sales of like under a 10. If it's a SaaS business, different industries command different prices of sales, but I just threw that in your for your reference. So let's kick off the list here. You can see DocuSign is the first stock gotten pummeled recently, guys, down 54% from its highs, sitting at now a $28 billion market cap. But the metrics look very strong still for this company. It's still expected to pull in, over $2.5 billion next year. 26% growth year over year, free cash flow at nearly $500 million per year. Now they have slightly positive net debt, but it's fairly close to zero, so I wouldn't really be too concerned about this. And for a company that's growing so rapidly with, positive free cash flow of about $500 million, a 10 price to sales or 11 price to sales here, not too shabby. Okay, so that's number one. Let's move on. Let's not waste any time here. Number 2 is Digital Turbine, ticker symbol APPS, 48% off of its highs. And you'll notice this trend throughout. A lot of these stocks are down 50% plus. Market cap here is only around $5.1 billion. Next year revenue is around $1.6 billion. So you can see price to sales already is going to be fairly low for this, around a 3. But their revenue is growing rapidly, 33% almost. Free cash flow positive. That's a good sign. And net debt here again is positive. It's a little bit more concerning here for this company because it is a smaller business, but I don't think it's too unmanageable here. And if you take a deeper dive into this business, you'll see that since they're generating a good amount of free cash flow every year, they can cover off this net debt if they need to. Moving on, number 3 is Unity, guys. This is a fan favorite. This one's down only 34%, so not as drastic as the others. Current market cap around $40 billion, so decently sized business right now. But because of the metaverse and kind of the trends going in favor of Unity, this should return some pretty big returns over time. Revenue right now is only $1.4 billion. It's growing around 28% year over year. It is negative free cash flow right now, which is kind of a negative point if you're looking at this for an investment, so that's something to consider. But their net debt is a negative 1.15 billion, so very healthy. Average forward price of sales is a 20 9. So this one is one of the most, if not the most, the most expensive stock here on this list, but also possibly the one that has the most potential with the metaverse. So something to consider. For me personally, I think it's still a bit too expensive. I want to drop a little bit more. At that point, I may consider it. Moving on. Number 4, Roku. So this one actually has rallied quite a bit recently because, they renewed their partnership with Google, with YouTube. Things are looking good again, but it's still down 53% from its highs. $30 billion market cap. Next year, revenue estimates around $3.78 billion. Revenue growth is very strong, 35% year over year. Free cash flow positive by around $330 million. Negative net debt of $1.6 billion. And that gives them a forward price sales of around 8.15. So this one's actually very interesting at current prices. It looks fairly cheap here with a low price of sales, high growth, strong free cash flow, good balance sheet. Everything seems to be lining up here for Roku. Probably want to look to do a deeper dive into at this point because it is one that I'm looking into. I may not pull the trigger on this. We'll see. But the metrics here from a high level look very promising. Moving on, guys. Number 5, Okta. So this is actually a cybersecurity play. 24% off of its highs. So it's still, fairly elevated if you look at the grand scheme of things. It's also still fairly expensive at nearly a 24 price of sales. So the second most expensive on the list here. Not exactly cheap at current valuation, so I'll probably wait for this. But the reason I threw it on here is because it's a cybersecurity play that's a huge trend in the next decade or so. And definitely do want to look at some exposure into that sector. So this could be one option. $34 billion market cap, $1.75 billion revenue, 37% growth year over year, free cash flow positive, negative net debt by around $500 million. Strong fundamentals, strong high level here, strong growth, one to consider for sure. Let's move on down the list here. We can see Teladoc, 69% off of its highs. This one definitely hurts. And, I personally don't hold this, but I know a lot of you guys do. This one, they made a huge acquisition last year. It looked promising, but now it looks like they actually overpaid drastically for that, and investors are punishing them for it. Currently at a $15 billion market cap, which is actually a smaller market cap, I believe, than what they paid for Livongo last year. So you're getting Livongo essentially free now at the current market cap that this is at. $2.57 billion in revenue expected next year, 27% growth. Free cash flow positive, not by a whole lot, but, a bit. Positive net debt, so this one's a little bit unhealthy here with the balance sheet perspective. And forward price sales of only around a 5.86. So again, another one similar to Roku, which looks quite interesting. The one thing I'd ding it on here would probably be its minuscule positive free cash flow and about $500 million in net debts. Not something I really like to see, but with a 69% discount off of its highest $15 billion market cap, telehealth possibly being a huge driver of growth in the next few years. Yeah, this one is quite interesting, but I do actually have another business on this list, which I personally own, that also has similar services to Teladoc, and we'll talk about that soon, but I think that one's a much healthier business. All right, so next up we have Wix at number 7, and this one, 60% off of its high, is only an $8 billion company currently, growing 20%, so it just made the cutoff here for what I was looking for. $1.5 billion in revenue, free cash flow positive, negative net debt, forward price sales around a 5.34. Now this one's not a business that I'm too excited about, but its fundamentals here from a high level look quite interesting, so I thought, I'd throw it in here. Maybe some of you guys would actually be interested in a business like this to, take advantage of more and more people wanting to build websites and simplicity of that, and Wix is kind of front and center for that. So it could be a company that sees continued growth for the next few years as adoption here continues with, people building their own websites for e-commerce or whatever. And with a 60% discount off its highs, could be quite enticing. Moving on. So this one's actually one that I'm not too familiar with. I threw it in here because it did filter out when I was looking through these stocks. It's 23% off its high, so it's a fairly resilient stock so far. Market cap of only $11 billion. $1.6 billion in revenue here, growth 26%, free cash flow positive, negative net debt, and a fairly acceptable forward price sales of around a 7. So Again, one that I'm not too familiar with, I want to throw it in here because some of you guys are interested in these kind of obscure businesses that you may not hear too much about. So there you go, that's number 8. Number 9 is Zendesk. This one's 40% off of highs. Another software type company, $12 billion market cap, $1.7 billion in revenue next year, 26% growth, positive free cash flow, positive net debt, not a good thing, and forward price sales around a 7. So another one to consider with the big 40% dip that it's seeing, strong growth expected, fairly decent price of sales. Only negative I can ding it on here is the net debt that's positive. Free cash flow won't be able to cover that for quite a while. So that's something to consider. If you do look into this business, this should be a point of consideration where you have to decide whether it's worth taking on that risk. Number 10 here, we're halfway through our list, Farfetch. So this one's 55% off its high. It's not a business I'm too interested in. I added it in here because the metrics look good. $12 billion market cap, $2.8 billion in revenue expected, 26% growth, positive free cash flow, negative net debt by around $660 million. So that's very strong. And a forward price of sales of only a 4. So, maybe worth looking into. It's one that I've kind of just overlooked over the years. Hasn't really been one that I've been too interested or even kind of remotely close to buying. But hey, with a 55% discount and a 4 price to sales with strong growth expected, this could be a pretty good cash cow over the long term. Moving on here, guys, we have Palantir, the fan favorite, 57% off of its highs. Current market cap around $38 billion. $2 billion of revenue or so expected next year, around 30% growth expected next year, $400 million of free cash flow expected next year. So this one, actually, they're probably going to hit $400 million of free cash flow this year. So next year should probably be around, I'd say closer to 450 to 500 million if they continue on that growth rate. Net debt here is negative 2.26 billion. So very, very strong here. And average forward price sales is a little bit high at around 19. But here with Palantir, you're getting a business that is one of the strongest free cash flow businesses on our list here, growing rapidly and a reasonable market cap today for a potential multi-bagger investment over time. Now, I'll be making a dedicated video on Palantir soon with kind of valuation and numbers and all that stuff behind it. So subscribe if you haven't so you don't miss that video. But Palantir, of course, was added to the list. Number 12, UiPath, another company I'm very interested in owning very soon. 51% off of its highs, $22 billion market cap, only $1 billion in revenue right now expected, 32% growth, so that's healthy. Negative free cash flow, it's kind of actually a neutral free cash flow, it's very close to that. And the company is focusing on keeping free cash flow neutral for now as they reinvest and such. So I don't expect to see positive free cash flow for a few years at least. Good thing is their negative net debt is around 1.8 billion, so they're in a good position here. Forward price sales is on the high end at around a 19.3. So it is one of the top, 3 when it comes to how expensive it is, but it is a fast growing business. So, if you like robotics and automation, that kind of stuff, could be one that's worth it here with a 51% discount essentially. Moving on, number 13, lucky number 13 is Twitter. 43% off of its high, $36 billion market cap, $6 billion of revenue expected next year. So one of the strongest showers on this list. 21% revenue growth expected next year, which is respectable. And Twitter is actually kind of accelerating their revenue growth. They're really focusing on revenue now and making money and that kind of stuff. So that's interesting. $500 million in free cash flow may actually be one of the best, if not the best on our list here. Negative net debt of almost $2 billion, so very strong. And an average forward price sales of only a 5.9. Twitter is a well-established business, not as exciting as some of these other names, but just based on these metrics here, it may be worth considering. Number 14 is Coupang. I made a dedicated video on this one as well, 61% off its highs. $47 billion market cap. These guys are a e-commerce company in South Korea. So, they're working on everything there. The logistics, food delivery, package delivery, everything. They even do like movies and that kind of like similar to Amazon Prime Video. So they're really trying to be kind of the Amazon of South Korea, but they're expanding slowly into like Taiwan, uh, Japan, and a few other markets over time. So that'll be very interesting to watch. $24 billion in revenue, 31% revenue growth, negative free cash flow, which is a huge negative here, negative 400 million. So you really have to understand this business if you want to back it up. I personally do like this business, even though they're losing a lot of money right now. It's because they're reinvesting heavily, and over time that should pay off. And you can see they have negative $2 billion in net debt. So they have a ton of cash still. That's not really going to be a problem for them, at least for the foreseeable future, even with this high cash burn here. And their price of sales is less than a 2. But this is an e-commerce play. They typically do have lower price of sales. But if you look at some of its peers like Mercado Libre or C Limited, those are trading much more richly, and Coupang is kind of getting the short end of the stick here. I think over time, it will outperform and will do quite well. Number 15, Goodrx. So this was the company I was referring to when we're talking about Teladoc, and how, there's another company I like better than Teladoc, and that's Goodrx. 37% off of its highs. Only a $16 billion market cap, so it's actually very close to what Teladoc is now. But their revenue is around $1 billion, so it is smaller than Teladoc. Their growth is very similar at 36%, but here come the positives. Their free cash flow is very strong at $257 million. They have negative net debt, so they're in a healthy balance sheet position. And their forward price sales is around a 15, which is a little bit high. It's definitely high when you consider Teladoc at only a 5 or a 6. But you're getting a company that's in a much, much stronger financial position here. So kind of have to decide what's more important to you. A strong free cash flow company, relative to its market cap and growth and stuff. Or would you rather a company like Teladoc, which is kind of known as the number one name in the space? You kind of have to decide which one makes more sense to you from an investment perspective. All right, so now we're getting to the tail end of our list here. Number 16 is SoFi. Fan favorite here on YouTube, 46% off of highs, $12 billion market cap, around a $1.47 billion revenue run rate. That's what's expected next year. 45% growth year over year, which is probably the strongest year on this list. It is free cash flow positive at $355 million, so very, very strong. Net debt is positive, however, at $2.16 billion. So this is definitely a concern and definitely something you should be aware of if you own SoFi. That's a lot of debt to overtake. And even with a high free cash flow, it's going to take a while to pay that off. And with interest rates going up and all that stuff, this one is definitely going to feel some pain. But the forward price of sales, even with such a high growth rate and positive free cash flow, is only so. I think this one is quite cheap. It's quite undervalued. If you can get past the hurdle of the net debt and manage the risk in your portfolio, definitely worth looking at the price. Number 17, Enphase. This is one I've not really spent too much time looking into, but definitely one I want to after adding it to this list. Only 23% off of its highs, so it's a fairly strong stock. $29 billion market cap, $1.93 billion in revenue expected next year, 40% growth year over year, which is very strong. Positive free cash flow slightly, negative net debt by $350 million, and only a 15 or so price of sales. So overall metrics across the board do check off for me to actually go in and look into this further. And hey, maybe I'll make a video on this if you guys are interested. Let me know in the comments down below. Number 18 rather, is Twilio. Twilio is a company that I have had an eye on for quite a while. I've been playing options on this here. 49% off of its highs. Quite a big haircut. $47 billion market caps, one of the largest on the list here. $3.65 billion of revenue next year expected. 31% growth, so very strong. The negative here, though, is that they are negative free cash flow currently. They're losing almost $1 billion. Positive to that is they have over $4 billion in cash sitting there as their net debt. So they can still cover this for a few more years, but there's probably going to be some dilution and that kind of stuff, which could add more selling pressure. 13 price of sales. It could be cheap if you're looking at this many years out. But considering that they're losing quite a bit of money, actually one of the worst on the list here, it's probably why investors are not giving this, a 15, 17, 19 price. Number 19 here, before we close off our list, is Carvana. So Carvana here has 28% discount off its highs, $48 billion market cap, pretty large company. Next year's revenue, $16.5 billion, 31% growth year over year. Another company that's losing money, negative $230 million free cash flow, huge net debt of $3.2 billion, and average forward price of sales of around 2.9. So this one's probably one I'm not going to look further into. Just added it here because it met the criteria I was looking for. But when I see high debt here and I see negative free cash flow, even though revenue growth is strong, there are many other businesses that I can look into that provide me strong revenue growth, but at much lower risk. So Carvana is not really one I'm interested in, but maybe it interests you. Anyways, guys, the last one here on the list is Redfin, 59% off of its highs, $4.237 billion market cap, so very small company compared to what it could be here with the real estate game. Revenue estimate next year, $2.5 billion, 35% growth, positive free cash flow expected of around $100 million, which is very healthy. Positive net debt of close to $900 million. So this is something that we definitely have to consider when looking at the possible investment. Price of sales around a 1.67. Dirt cheap stock. The cheapest, I believe, on this list, even cheaper than Coupang here. So there's definitely a risk with this one because it's tied to real estate, and if real estate sees a correction, this one will also see a correction. So you kind of get double whammied here. But one that I think was worthwhile adding to this list because it's trading at a pretty attractive valuation currently. So guys, these were the 20 stocks that I wanted to share with you today. And I think a lot of these companies will do very well over time. Some of these companies may not if they don't continue executing, or their debt just gets much larger, that it gets unmanageable. They could see a lot more pain in the future. But I think there's a good chance that majority of these companies are larger companies in a few years from now than they are today, especially with them being 30, 40, 50, 60% plus off of their highs. So hope this was useful, guys. Screenshot this, do whatever you want with this list here. Hopefully it was valuable information. And if it was, all I ask, like button, subscribe, and turn on the bell notifications so you don't miss any other future videos. But anyways, guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next.